Next chart we have is the funding and open interest. Funding means periodic payments, either to the traders that are long or to those who are short, based on the difference in price between perpetual contract markets and spot. So, funding becomes effectively actionable when it has an inverse correlation with price. So, for example, when the price is going down but funding is increasing, it means that spot is buying while the leverage or margin traders are trading the increase in price, which leads to added strength for the demand side because of sell side liquidations. Similarly, when the price is going down but the funding is increasing, it means that margin traders are buying the dip. This can lead to sell side liquidity to increase as margin traders get liquidated, ultimately causing a liquidation cascades. Chances of liquidation cascades increase if the collateral which these traders are using is the same asset rather than the stable coin. So average funding rate, the danger zone is above 0.08%. Currently it is at 0.0112%. So we saw here that we were anticipating a squeeze, and when such a market conditions are there, then we can expect a dark mall candle, or when buyers are matched equally with the sellers with high leverage. This indicates a choppy market. A candle pattern such as dark mall or a range chop is probable in such conditions. So liquidating shorts and longs both. This is the open interest. So what does open interest mean? It is the total number of outstanding contracts on all exchanges. Total open interest has come off the highs this week, and it has come down to approximately 10 billion following the expiry of 26 November contracts. Now if we see open interest and funding both together, we can see that the funding has started to rise. The open interest, we see it is at very high rates, and it actually jumped to these levels after the ETF. ETF in the US market has significantly increased the open interest. CME market now represents over 19.3% of all open interest, and almost double from 10% dominance in early September. This is the leverage, and it is also at an all-time high, and it still looks pretty dangerous, but the nature of leverage has changed. We see that leverage is there is a lot of short people. There are a lot of people who are shorting, and there are a lot of people who are long also. So it is kind of balancing each other out, but the leverage is very high in the system right now. We will see it in confidence to the VL ratio also. Now last time we saw this chart, and we noticed that there has been a 91% increase. That indicates that the top 10 deposits take 91% of the deposit volume across all exchanges in the hourly time frame. VL deposits are usually not a good sign. And if you see last 3 days, this is the number of VLs, an historic representation. So whenever we have seen the spike, we see this dump, the spike. We saw a little bit of correction here. Spike, this correction at 66. Now also it is spiking. So what we saw was that there was an increase of 39,000 BTC inflow mean, which is the average BTC inflow to all exchanges, and it has skyrocketed since yesterday. Above is this represents a downside risk or a weakness zone. The possibility of a dump in the future has emerged because of these whale inflows. So what it can do is it can rally up, liquidate the shorts, and then dump, liquidating the longs. These are the whale games. You can see another chart which shows this. This has been the inflow from the whales in the past 2 days, 3 days. And if we see these three charts in confluence with the funding rate, where we were anticipating a dark mall, because the funding is also rising now, and the open interest is at all-time high. The whales inflows are increasing, so it is a pretty dangerous